I welcome you for the today's study circle on minimum alternative tax and alternate minimum tax. We have thus and renowned faculty C. Vishnumoorthi sir. I request Bangalore Bank Chairman to escort the speaker and welcome him with the flower bouquet, and also request him to present among us. Members, coming to end the programs, we have an unique program on 3 days workshop on transfer pricing basic level for chartered accountants. A very good renowned faculties are addressing full 3 days workshops on basic models. It is from 12 July, 13 July and 14 July. I request members to register and make utilize of this program. And next week we have a study circle on issues in corporate governance practice in India. And on 25th July we are having recent issues and judgments in capital gains by C.A. Narendra Jain. Dear members, today coming to today's topic, minimum alternative tax and alternative minimum tax. C.A. Vishnumoorthi sir is with us. He is a chartered accountant and also a law graduate. He has been practicing for over 30 years now. He is the proprietor of Vishnu Ram and Co. Chartered Accountants, Bangalore. He handles matters relating to direct tax, indirect tax, IT and the company law. The person with having knowledge in all the subjects, normally we look the person's capability to normally indirect tax expert, direct tax expert and company law expert. But Vishnumoorthi sir having expertise in all the subjects, he handles all the subjects. With this brief introduction, I present before you C. Vishnumoorthi sir. Welcome, sir.
All of you. So we are going to talk about minimum alternative tax. I'm sure all of you have heard this phrase minimum alternate tax or MAT. Most of you have heard it. Can you just tell me where did you read these words minimum alternate tax or MAT? Very shockingly, as I was preparing for today's talk, I realized neither the expression minimum alternate tax or MAT is found in Income Tax Act 1961. It is really shocking. Neither 115 JB nor anywhere else in the Act you will see this word. Still, it is so popular. If you call the tax payable under section 115 JB by any other name, people will not understand. If you read section 115 JB, I just read it for your benefit. Nowhere it uses the word minimum alternate tax. It simply talks of special provisions for payment of tax by certain persons. No, sorry, this is 115 JC. 115 special provision for payment of tax by certain companies. It stops with it. Nowhere it uses the word MAT. But still, since the word is so popular, we will use that word for the tax payable under section 115 JB. Now, what is the background of this MAT? Probably Reliance Industries is the reason for introduction of MAT. There was a point of time when the company used to make huge amounts of profit. It used to reward the shareholders with huge amounts of dividend. Executives were being paid huge amounts of compensation. But still, when it comes to the total income, it would be zero. Tax that is paid to the government was zero. So they coined a word called zero tax companies. Zero tax companies doesn't necessarily mean that they do not pay any taxes, but the amount of taxes that they pay are far less than the tax companies that are similarly placed were paying. So in order to, it is not a loophole. What used to happen is a company like Reliance Industries will set up a plant in a backward area where there will be a lot of incentives. They will make the profit, but because of that incentives, they could get away without paying the taxes. Therefore, the government thought it fit that when these companies can pay so much to the shareholders and to the executives, why not make them pay something to the government also? This is the genesis for minimum alternate tax. Now, when we talk of minimum alternate tax, we understand when we use the word alternate, there is something else also. That is the normal tax we are talking of. So we have tax which is calculated based on the provisions other than 115 JB, for which we will use the word normal tax, and the tax that we compute under section 115 JB. Now coming back a little, when I said a company like Reliance was making profits and not paying the taxes, it is not that they were doing something illegal. There was a promise that was made by the government that if you go and set up a unit there, you don't have to pay tax. This is a promise that is given by the company, and when somebody based on the promise sets up a unit and earns a profit but doesn't pay the tax, he is not committing any offense. There is nothing illegal about it. In fact, if somebody were to come later and ask him to pay the tax, it will get hit by what is called as promissory estoppel. You have made a promise saying that if I set up a unit in such and such place, you will give me exemption. Thereafter, by seeing the kind of profit that I am making, if you demand tax, you are actually going back on your promise, which is not permitted under the statute. That is why we have got something like promissory estoppel. Therefore, even though the companies were asked to pay the tax, they were given a sort of benefit. You pay the tax today. Tomorrow, under certain circumstances, we will allow you to set it, or rather, we will allow you to set up this amount of tax what you are paying today as MAT. In other words, this is something like a tax credit. Like in VAT or GST, you have got input tax credit. That is nothing but the tax that you have paid will be allowed to be set off against the tax that you have to pay subsequently. So they are given the tax credit benefit also. Now, to ascertain what is the amount of tax that these companies will have to pay, that is the task before us. The entire session is going to be, we are going to deal in this entire session about how to compute this tax base and the related tax that is payable as MAT. Then what are the consequences of that? First of all, MAT rate is at 18.5%. Is it a magic number? Or is there any basis for determining it at 18.5%? There is a concept of what is called as effective corporate tax rate. This is nothing but the total taxes paid by corporates in India divided by the total profits made by all these corporates. You get that? You consider all the corporates in India as one group, add up all their profits, add up all the taxes that they have paid, divide the taxes paid by the profit that they have made, you arrive at a percentage. This is nothing but the effective rate of tax for all these corporates. So that has been taken as a basis for determining this MAT. So they are saying companies which are not paying the taxes, look here, there is all other companies put together. Effectively they are paying 18.5%. You also pay at least 18.5% tax. So MAT rate is 18.5%. Of course, when they actually pay, there will be surcharge, there will be cess, all those kind of things. Otherwise, effective rate of MAT is 18.5%. Like I told you, the whole exercise or the entire discussion on 115 JB revolves around determining the amount on which this 18.5% has to be calculated. Under the other provisions of the statute, we call the amount on which tax is payable as a total income. Whereas under 115 JB, we call it as the book profit. Let's get it very clear. This is book profit is a sort of total income for the limited purpose of calculating the MAT. How do you arrive at this book profit? What do you understand when somebody uses the word book profit? If you actually analyze this, it is profit as per your books of account. You prepare your profit and loss account based on your books of account. That is the profit which can loosely be described as book profit. All of you will agree with that? Now, one is to prepare a book or a profit and loss account exclusively for the purpose of 115 JB. I am sure all of you are quite familiar by now that profit would mean different things under different circumstances, or for that matter income. Now for the purpose of income tax, the word income has a different connotation, or profit for the purpose of income tax. Today it has to be computed by applying your ICDS, Income Computation Disclosure Standard. Is it not a separate method of calculating the profit for the limited purpose of calculating the income tax? Now, for the purpose of declaring dividend or for the purpose of presenting your financial statement to the shareholders, you prepare profit and loss account basically to tell them this is the kind of profit you have made. Then again you employ a totally different method. The profit that you are arriving at is based on accounting standards and all other things that you are going to apply in determining it. So profit has different connotations under different circumstances. You have to accept that. Once that is accepted, the idea of book profit becomes easier to understand. So book profit cannot be understood by applying a common sense. It is a technical term. It has got a technical definition. So what they are saying is, when it is book profit, you prepare a profit and loss account by applying the accounting standards which you are expected to apply in preparing your profit and loss account which you present to your shareholders. Now here there could be some confusion. Let me repeat the thing. One is you prepare a profit and loss account which is part of your annual financial statement for the purpose of presenting it to your shareholders. The statute puts it very nicely by saying that the statement of profit and loss account which you are going to present in the annual general meeting. What does it actually mean? It is a statement of profit and loss account which you are going to present to the shareholders. Now, Companies Act, by the way, this MAT is applicable only to companies, let's be clear on that. So all the discussions we are going to make is with reference to the companies. So companies are required to prepare their statement of profit and loss account, profit and loss, or simply profit and loss account. Let's use the word profit and loss account, that is convenient. You applying the accounting standards prescribed by the institute, which has been given legal sanctity in the Companies Act itself. Clear? Now, this statement of profit and loss, which is prepared by applying the accounting standard, is understood to be showing a true and fair view of the profit made by the company. That is the base for starting to purposes of MAT. Let's understand that is not the book profit. Whatever profit is shown in the profit and loss account, which is prepared by applying the accounting standard, is not the book profit, but it shows a net profit. That becomes the starting point for determining the book profit for the purpose of 115 JB. There are certain adjustments that are required to be made to the net profit shown in that profit and loss account to arrive at this book profit. Basically understood, it is like this. We have the concept of EBITDA. Are you familiar with this word EBITDA? Earning before interest, depreciation, tax and other amortizations. Then we have profit before tax. Then you have profit after tax. Profit after tax is nothing but your net profit. This book profit is almost akin to profit before tax. That means it is a profit which is available to the company to be given to the shareholder after paying the taxes applicable on that. Correct? Now, on this PBT or the profit before tax, if you calculate MAT at 18.5% plus the surcharge, the leftover is the amount that can go to the shareholders, which they can use in any which way want. Or the profit before tax is the tax base on which you will have to calculate 18.5%. Whereas the profit and loss account that we are going to prepare under the Companies Act shows net profit, which is a tax after, which is a profit after tax. Okay. So we have to start from net profit that is shown in the profit and loss account. Now, it may so happen that companies, for whatever reason, may not hold their AGM in time, or it might get postponed, or in the AGM they may not present the profit statement, financial statement. Otherwise, a statement prepared for the purpose of presenting it to the shareholders should be the ideal one. But because of these contingencies, to take care of these contingencies, law provides that for the purpose of 115 JB, you will have to prepare a profit and loss account. It is not that you take into account the profit and loss account that is prepared by the company for providing it to the shareholders. Not that way. They say you prepare the profit and loss account by applying the same accounting standards as you have applied for preparing the financial statements which you intend to present it to your shareholders. Now, on the basis of such profit and loss account, you arrive at the net profit. Now, if you have prepared the profit and loss account by applying the accounting standards, got it audited, when you get it audited, what is the assurance that you are getting? This financial statement or the profit and loss account has been prepared by applying the applicable accounting standards. That will serve the purpose, but it can be used only where it is prepared. There is no compulsion under the Income Tax Act to prepare such financial statement. Under the Companies Act, you have the compulsion. Under the Income Tax, there is no compulsion to prepare such financial statement to be presented before the shareholders. So, if you are prepared, use it. If you are not prepared, you cannot say that I have not prepared a profit and loss account for the purpose of the Companies Act, therefore you cannot ask me to pay the MAT. Otherwise, that situation might arise. Therefore, the law says you prepare a profit and loss account in accordance with the accounting standard. Once you have prepared this financial statement, or you have considered the financial statement prepared for the purpose of the Companies Act, you will have net profit in that. From that you make the adjustment and arrive at the book profit. Now, before proceeding a little further, the nature of the section 115 JB, under the Constitution there is one article, very interesting article, Article 265, which says that no tax shall be levied or collected without the authority of law. That means there should be a charge which is created or a declaration which is made that so and so shall pay this much amount of tax. This is called charging section. Normally we call section 4 as the charging section. But for the purpose of MAT, 115 JB acts as the charging section. 115 JB says, if the tax payable by a company under the normal provisions is less than 18.5% of its book profit, then the book profit shall be treated as the total income and the tax payable by such company shall be 18.5% of such book profit. So, charge 115 JB also acts as a charging section, and it also quantifies the amount of tax that one has to pay. Once the quantification is done, you know that tax has to be paid. This, like I explained a little earlier, it may appear to be something where the government is going against the promise that they have made. That's why they are giving you the tax credit. Now, what is the amount of tax credit a company gets when it pays the MAT? Every company in the first place has to pay a minimum tax of 18.5% of its book profit. Come whatever may, that is the minimum they have to pay. It may so happen that their normal tax payable because of all this incentive will be less than this MAT. Then the difference between the MAT and the normal tax will be allowed to such companies as a tax credit which it can carry forward. Now, after it gets carried forward, how does it utilize? In the following years, if in any year, if the tax payable by the company under normal circumstances, that is under the normal method, is more than the MAT, then the difference between the normal tax and the MAT can be set off against this tax credit, or the tax credit can be set off against this, which what actually it means, under no circumstances the company cannot refrain from paying MAT. To the extent of MAT, year on year it has to pay. Over and above that, if there is a requirement to pay, that can be set off against this tax credit. This carry forward, again, there is a limit. It can be carried forward for a maximum period of 15 years. Thereafter, it gets lapsed. No interest will be allowed. It is called a tax credit because the government in their accounts will show that this amount may in future it may be claimed by the company. Therefore, it has to be shown as a liability. So that's why it is called as a tax credit. There is a small point on this foreign tax credits. You know, if an income has suffered tax in a foreign country and it is also required to be subjected to tax in India, then again the tax payable in India, the tax paid in the foreign country can be set off, or the tax paid in the foreign country is allowed as a tax credit. But the amount of that foreign tax credit cannot be more than the tax payable under the Income Tax Act of India. If it is more than that, then that tax credit goes a waste. So similarly, for the purpose of tax credit under MAT scheme, what happens is that if the MAT is paid by utilizing this foreign tax credit, then foreign tax credit, which would have become a waste had it been set off against the normal tax, such excess will not be given as a tax credit. Otherwise, what happens, by using the foreign tax credit, you will say, I have paid a MAT. And if you are allowed to carry forward as a tax credit, you are actually asking Government of India to pay you certain amount, which initially you have paid to your foreign government. Because the foreign tax credit is nothing but the tax you have paid to your foreign government. So if that is allowed as a tax credit in India, it will virtually amount to you asking Indian government to give you credit for the tax that you have paid in foreign country, which is unthinkable. So that is not allowed. Now, for the purpose of computing the book profit, companies are classified generally into two categories. It is only because now that we have got Ind AS compliant companies. There are companies with certain criteria. They have to prepare their financial statement by following the Ind AS standard, I mean Indian accounting standards. There are Indian accounting standard and simple accounting standards. So companies which are required to prepare their financial statements by following the Indian accounting standards are classified as Ind AS compliant companies, and the companies which are not required to do so are called as AS compliant companies. Rules are slightly more complicated for Ind AS compliant companies. There is one more type of company called 115BA, if you see the Income Tax Act, which is a newly introduced section, where it says for certain types of domestic companies, they can get away by paying only 25% tax if they fulfill certain conditions. Basically, they should not seek any brought forward losses, they should not claim any carry forward benefits. So under certain circumstances, they can opt to pay the tax under 115BA. Now 115BA starts with a non-obstante clause called as notwithstanding anything contained in this Act. 115JB also starts with a non-obstante clause saying that notwithstanding anything contained in the Act. So there are two sections which says notwithstanding anything contained in any other provisions of this Act. Now the question that arises for us is to decide whether 115JA has to be, JB has to be ignored for the purpose of 115BA, or whether 115BA has to be ignored for the purpose of 115JB, because both are having this opening words as notwithstanding. There is a Supreme Court judgment which says that when there are two sections which opens by saying notwithstanding anything contained in any other provisions of the statute, the one which is enacted subsequently will prevail. 115BA is enacted much later than 115JB. So 115BA will survive and 115JB will fail. What does that mean? Notwithstanding anything contained in any other provisions including 115JB, 115BA has to be given effect to, which technically means companies which are opting to pay that 25%. It is not that turnover based, we will discuss a little bit. There is a set of companies whose turnover is below 150 crores who need to pay tax only at the rate of 25%. This is a new provision that I have introduced. It is not those companies. This is another company irrespective of their turnover. They can pay 25% subject to certain conditions prescribed there. If it is such a company, then for them MAT provisions are not applicable. Now, if a company has made a loss, is it required to prepare, or rather is it required to compute its MAT liability? Or if a company, for example, or the simple question is whether every company is required to compute both MAT obligation and normal tax obligation every year. Yes. This is fundamental question. It is necessary because MAT becomes operative only when the normal tax payable by the company is less than 18.5% of its book profit. So in order to arrive at book profit, you have to follow 115JB. In order to find out whether it is less than the normal tax, you will have to compute the tax and the total income under the normal provisions. So every year, every company has to compute both its total income, both under the provisions of normal provisions other than 115 JP, and also its book profit under 115 JP. So this becomes a little Herculean exercise. Now, math computation is more often an accountant's job, because if you see the language that is employed in 115 JP, it looks very complicated. But basically, if you try to understand the concept, like I told you earlier, it is nothing but arriving at your profit before tax. There will be additions, there will be deletions. We will explain each of these items, then you will realize it is actually not that complicated. It is only because the way it is presented in the statute, it looks quite complicated. If you follow the accountancy principle thoroughly, it is not at all a complicated exercise. That's why I said it is basically an accountant's job. And that is why probably they think even income tax officers may find it difficult. They have designated chartered accountants to give a certificate certifying the correctness of computation of book profit. There are certain foreign companies whose financial year ends on a date different from 31st March. But for the purpose of Indian Income Tax Act, they have to pay tax on their income for financial year ending on 31st March. Because previous year is always 31st March. Now, for the purpose of MAT, you will have to arrive at the book profit for the year ending 31st March. That means there is a need for them to prepare a financial statement according to the accounting standards for the year ending 31st March. It may not be presented to the shareholders, but for the purpose of 115 JB, it has to be prepared. And while preparing, it gets spread over 2 different years. They will present their financial statements to the shareholders for the year ending that they have chosen, which could be December 31st. But for the purpose of MAT, they have to have a financial statement for the year ending 31st March to 31st March. Since they have to prepare 2 financial statements for providing to the shareholders, because their period falls under 2 different accounting years, there can be a difference in accounting standards that they are employing. So in such cases, whatever is applicable for the period for which they are preparing that books of account, that accounting standard will have to be taken into account. Now coming to computing the book profit, we start with the net profit figure in the statement of profit and loss. All of you have to visualize where is that line item called net profit or loss in that profit and loss account. Normally it is profit before tax, then you deduct the taxes, current tax or deferred tax, all that. After that, that net profit line item will come. Then there will be appropriations. That net profit might be appropriated for proposed dividend, for some other specific reserves it might be appropriate. But you must remember that is an appropriation account. We are not concerned with that. We are looking at the profit and loss account. So that net profit becomes the starting point. This we saw. Now, first adjustment is with regard to income tax. I told you, we are trying to reach the figure of profit before tax, and we are starting with the net profit, which is a figure after tax. That means in order to reach at profit before tax, what should we do to the net profit? We will have to add the taxes back, as simple as that. So income tax is added to that net profit figure. Now when you talk of income tax, what all items will get included there? What about the interest payable on taxes? Whether it will also be part of income tax? It will. What about taxes paid in foreign country? Will it also form part of the income tax? Because in your profit and loss account, you are going to show it under taxes only. Along with the line item called income tax, you are going to show the foreign tax also. So naturally that will also get added. What about dividend distribution tax? Should it be added back? That also gets included in that line item after PBT, no? You will have the profit before tax. Then from there you deduct all these taxes, be it income tax, be it interest on delayed payment of taxes, be it foreign tax, or be it in dividend distribution tax. All those things come after that. So it has to be necessarily added back to net profit to arrive at what is we call it as the book profit. Only one item gets excluded and it looks like an oversight. You know, today when a company buys back its shares, there is a separate provision to take care of the tax implication. It is called 115QA. If a listed company buys back the shares, the tax has to be paid by the shareholder, because when he give the share back to the company under a buyback scheme, he is actually selling his shares back to the company. So it is a capital gains issue. By applying the normal provisions, he will compute the capital gains, and on that he will pay the tax. But in the case of companies which are not listed, this provision was being misused in many cases. Just to give you an example, it is a closely held company. If the shareholder wants the money from the company has to declare a dividend. If the company declares dividend, there will be dividend distribution tax. So what you do is, shareholder sells the shares back to the company. There will be capital gains in his hands now. Now, if he is buying a house or constructing a house, by investing in that residential house, he will claim exemption from tax on his capital gains. So people used to arrange their transactions in such a way that whenever the shareholder required funds for the purpose of making investment like this, they used to resort to what is called share buyback. So in order to plug this loophole, amendment has been made whereby whenever a company distributes any amount to the shareholder on buying back its own shares, company has to pay tax on such disbursements. This is under 115QA. This is also a tax paid by the company like a dividend distribution tax. Unfortunately, in that 115JB, while listing the items that need to be included under income tax, this amount has been kept out. So this is one saving. What about penalties payable under the Income Tax Act? Is it included along with the taxes on income in your profit and loss account? Or will it be under some other line item in your profit and loss account? It will generally be other line items. It could be miscellaneous expenditure or whatever you want to call it, but it will not be part of your taxes. Therefore, penalties paid, be it under income tax or wealth tax, wherever it is, that need not be added back. In other words, while computing your book profit, you will be getting deduction towards this penalty payment. You will not be getting deduction for income tax payment, but you will be getting deduction for penalty payments. Reserve creations. There are statutory reserves that need to be created. For example, if somebody company has issued preference shares and thereafter it redeems it, there is a requirement to keep aside some amount as capital redemption reserve. If the company has issued debentures, there is an obligation to create debenture redemption reserve year on year. Now the question is whether what one should do with these reserves to arrive at the book profit. These reserves get debited to your profit and loss account Do you agree? Because you create the reserve by debiting it to profit and loss account. Now, if it is debited to the profit and loss account, it will go to reduce your net profit. Now, whether these reserves are any sort of any expenditure incurred for earning the profit, is it not actually a profit which is available at the disposal of the shareholder? So should the company not pay tax on such amounts? So therefore, the law provides that such reserves created should be added back to the net profit. Of course, we write that if it has been debited to the profit loss account. Everywhere you will see this. If it is debited means if it has gone to reduce your profit for the year, then it has to be added back to arrive at your book profit.
Yeah, but generally the companies would put it in the profit and loss appropriation account.
That is what I am saying. If it is debited to profit and loss account before the line item net profit, we are not looking at the profit and loss appropriation account. Then difference between provision, because similarly there is a rule for provision. What is the difference between provision and reserves? Anybody?
Provision is for loss.
Provision is for loss.
Charge against revenue. Charge against revenue.
One is a charge, other one is an appropriation. Yeah, probably that is a very nice way of putting it. Reserve is nothing but, creation of reserve is nothing but appropriation of your profit. Provision is a charge which need to be provided for in determining the net profit. Now, some people may make provision just to reduce the profit that they want to show, which we call it as creating hidden reserves. So even though it is described as a provision, in reality it is a reserve. In fact, there is a prohibition against creation of such hidden reserves. Now, provision for unascertained liabilities. There are certain ascertained liabilities. Simply putting it, you have incurred an expenditure for which you have not made the payment. You will show it as an outstanding liability. It is also a sort of provision made for making payment to a known liability. There is no problem about it. It gets debited and it has to be legally or appropriately, it has to go to reduce the profit. So in arriving it is not net profit, it has to be reduced. There are certain uncertain liabilities. For example, somebody may have a contingent liability. By apprehending that I may have to meet that liability on a future date, I will keep aside some of my resources by creating a provision. This is not a charge against the profit. It may become a charge against my profit on a future date. At least during this year it is not a charge. Therefore, such provisions which are created for uncertain liabilities will have to be added back to arrive at the book profit, because we have started from a net profit, which is a figure after charging that provision. Now, this ascertained and uncertain liabilities, there can be some issues. Gratuity payable to employees. Is it an ascertained liability or is it an unascertained liability? Now, as far as gratuity is concerned, the figures may keep varying because as the employee puts on more number of years of service, the gratuity obligation will keep increasing because you are liable to pay him the gratuity liability based on his last drawn pay. So the liability keeps changing, but because that liability varies, can you say that the liability is unascertained? You have an obligation under the statute to pay him the gratuity. Therefore, it is an ascertained liability. Even though the quantum is not ascertained exactly, it will nevertheless be an ascertained liability. Therefore, if you made a provision for payment of gratuity to employees, it need not be added back. Sometimes you make provisions for ascertained liabilities, but it may so happen that you may not have to pay that liability in future. Then what do you do generally? Simple. You have made provision for audit fees. It is an ascertained liability. It should be deducted in arriving at your book profit, but it may so happen that for auditor, for whatever reason, he decides not to take the fees. What do you do with that liability? You will normally write it back. Is there any adjustment called for such write backs? It will go to increase your profit. And that is the right thing to do. Therefore, no adjustment is called for such write back of ascertained liability. Unascertained liability, adjustments are required. Because in the following year, when you write it back, it will go to increase your book profit. But in the first place, you have not claimed any deduction for that. Therefore, when it is credited, in the year in which it is credited, it should go to reduce your book profit. Provision for losses of subsidiary companies. Normally, holding company doesn't provide for the losses of subsidiary companies. As an extraordinarily prudent measure, somebody may keep aside some amount. Otherwise, that amount doesn't make any sense because you are not going to set it off against the losses of the subsidiary company. But very strangely, things may so happen, a company may be a partner in a partnership firm. The firm has incurred a loss. That loss will come and hit the company's profit and loss account. If the firm makes a profit, that profit will also get included in the profits of the company making the investment, which is a partner. Whether any adjustment is called for that. These are all accounting issues. You are a partner in a firm. Firm makes a profit. So what happens to your profit and loss account? Your share of profit has to be credited to your profit and loss account. And to that extent, your investment in the firm will go up if you don't receive the money. Similarly, when it makes a loss, your investment in the firm will come down, but the loss will get debited to your profit and loss account. Whether any adjustment is called for this kind of transactions, there is no adjustment for this kind of transactions.
The previous thing, I don't know if I missed it. Did you give an example of an unascertained liability?
Beg your pardon?
Can you give an example of an unascertained liability?
Unascertained liability. Yeah? Gratuity is an ascertained liability today. Leave salary, for example.
Bad debt. Bad debt is also.
Bad debt is not a liability. It is a diminution in the value of an asset.
Provision for bad debt.
But see, what happens is, debt is an asset, right? Debt is an asset.
Yeah.
There is an impairment in the asset or a diminution in the value of the asset. For that purpose, you make a provision. When you call it a provision for bad debt, it is for diminution in the value of the asset you are making a provision. It is not for any liability.
But is it ascertained? So we feel that the bad debt may go bad.
Correct.
It is not ascertained that it will definitely go bad. So
No,
for that
no,
extent,
we have a separate line item. Any provision you make for diminution in the value of any asset has to be added back. Now, this is a provision what we are talking of is for liabilities. Unascertained liabilities, I will give you another example. You have given guarantee to a third party. Bankers have not called for, rather let us say bankers have invoked the guarantee. But the principal borrower, if you see his financial strength, he can definitely repay that amount. even in case if it doesn't repay and you are made to repay the amount, you have the right to recover that amount from him. Again, that amount, how much has to be paid to the bank is still not quantified, because you do not know how much interest has to be charged after it is called for. So it is, if you have made a provision in your profit loss account, it is a provision that you have made for an unascertained liability. In the first place, the liability is contingent. You should not have made a provision. Even if you have made a provision, it would be a provision for some unascertained liability. Dividends paid, interim dividends paid will get debited. Final dividend proposed will get debited to your profit loss account. Somebody will say it will be part of your appropriation account. If it is an appropriation part, nothing to worry. On the other hand, if somebody has debited it before net profit, then adjustment is called for. It has to be added back to arrive at the profit. Now, for charitable institutions, I said 115 JB is applicable to all companies. There can be charitable institutions which are in the nature of companies. In 1956 Act, there used to be a section called Section 25, under which a company can be incorporated. It is a company, but its object is not to make profit. It is a charitable institution. Even under the New Companies Act, under Section 8, there is a provision which enables the registration of an organization as a company under the Companies Act. Now, strictly speaking, all these 115 JB provisions will apply to such companies also. When you say 115 JB is applicable to such companies, they have to prepare a profit and loss account by applying the accounting standards. They will have book profit. If they have book profit, 18.5% of such book profit will have to be paid tax. How do you ensure in such cases that those companies or charitable institutions do not pay the tax? There is an adjustment here which says that if any income which is exempt under Section 11 is credited to the profit and loss account. Here I have mentioned only the expenditure. There is another clause which says that if there is any income which is exempt under Section 11 or under Section 12, if it is credited to your profit and loss account, then that has to be deducted from the net profit. So your profit and loss account will show a net profit, but the moment you deduct these kind of incomes which are exempt under 11, then the book profit becomes zero. So that is how they end up not paying any taxes. Similarly, items which are excluded from levy of tax under Section 10. You know, under Section 10 there are many items which are exempt. For example, agricultural income is exempt. Your share of profit from a partnership firm is exempt. But for the purpose of preparation of your profit loss account, it has to be credited to profit loss account. So in your net profit, these incomes will get included. If no adjustment is made, they will suffer tax. So in order to ensure that they don't suffer tax, this adjustment is provided in 115 JB, which says that if an item of income which is credited in the profit loss account is exempt from tax under Section 10, then such income will have to be deducted from the net profit. Except one, that is Section 1038, which is nothing but the capital, long-term capital gains which has suffered STT. On that, one is required, companies are required to pay VAT. Now, in income tax, all of you are aware, there is on Section 14A, disallowance of expenditure relatable to exempted income, which is always a bone of contention. Even under MAT, you have this provision. If an item of income is not taxed, it is natural that expenditure relatable to such income should not be given a deduction. If deduction is given, actually this goes to reduce the other income, non-exempt income. That is how actually it happens. So therefore, there is a provision which says that if there are any expenses which is debited to your profit and loss account, which relates to income which is exempt from tax, then these expenses will have to be added back to your net profit to arrive at the net profit to arrive at the book profit. Now, how do you compute the expenditure which is attributable to exempted income? Under normal provisions, we are very clear. There is one section 14A which provides that either you compute or your computation, if it is not acceptable to the assessing officer, he will compute. For him, there is a rule, that is rule 8D. Under 8D, there is a formula-driven item which determines the amount of expenditure attributable to exempted income. Now, 115 JB is more or less a sort of self-contained code. Whether we can go to section 14A and take recourse to rule 8D to quantify the amount of expenditure which is attributable to exempted income. There is one subsection 5 of 115 JB which says that other provisions of the Act will apply to computing the income under 115 JB if it is not specifically excluded. What does that mean? 14A will become applied, 14A becomes applicable to quantify the amount of expenditure which is attributable to exempted income. Now, beg your pardon?
Your slide, your same slide. Is it 115 JB applicable to section 8 to the company or not applicable?
It is applicable. It is applicable. But what happens? It becomes a just academic exercise. It will not generate any tax for the government. Now, one interesting that can happen is a company has agricultural land. Company sells the agricultural land. It derives huge profit. That profit will have to be credited to profit loss account. There is no dispute on that. Whether the company is required to pay MAT on such income. Now, profit on sale of agricultural land, is it agricultural income? Why profit on sale of agricultural land is not taxed?
It's not a capital asset.
It is not a capital asset, but it is not an exempted income under section 10. What is provided here is only what is included under section 10. So how do you deal with this profit which arises by sale of agricultural land? It definitely gets credited. So technically it will suffer MAT. Fortunately, matter has been taken to Supreme Court. They said profit on sale of agricultural land is akin to agricultural income. Therefore, it would be exempt under section 10. Therefore, if it is exempt under section 10, then it has to be excluded or deducted in computing the book profit.
So all section 10 items except section
1038, yes,
is
they will get excluded. This is Indian law. Foreign companies. What about foreign companies? They are companies in the first place. Are they liable for MAT? This was a burning issue. Now it is more or less sorted out. Foreign companies will not be liable for MAT if they happen to be resident of a country with which we have a double taxation avoidance agreement. For example, let us take Microsoft. Microsoft is in US. With the US, we have a DTA, Double Taxation Avoidance Agreement. Therefore, Microsoft becomes a company which is a resident of a country with which we have a DTA. Therefore, they will not be covered by the provisions of 115 JB. But this comes with a rider that such companies do not have a permanent establishment in India. If they have a permanent establishment in India, then 115 JB becomes applicable to such companies. Now, if 115 JB becomes applicable to such companies, the next question that will arise is whether such companies' profit for their global operations will become liable for 115 JB, or only the Indian operations will become liable for tax under 115 JB. Because it says start from net profit as per profit and loss account. Now, are they required to prepare a separate profit and loss account under the Companies Act for their Indian operations?
Anyways, they have to do it. Anyways, they have to do it a separate P&L for the income tax purpose.
That is not the P&L we are looking at. We are looking at a P&L prepared under the Companies Act. This can create confusion, but since the word used is book profit, that is a profit which is determined based on the books of account. They will maintain books of account only for Indian operations. This is how they have gone about finally arguing. So books are maintained only for Indian operations. Therefore, book profit relating to their Indian operations alone become relevant, not their global operations. There are foreign companies which are earning profits in India. Now, if they were to make, if they were to be paying this MAT, the tax will be at 18.5%. Certain companies, they come to India, your FIIs, mainly FIIs, they come to India only for the purpose of dealing in stock market. On the transactions of securities on which they make capital gains, they are required to pay only 10%. If their tax liability is only 10% under the normal income tax provisions, if you make them pay tax under 115 JB, they will end up paying 18.5%, they will run away. Therefore, there is a special provision under 115 JB where they say, in respect of these foreign companies, if there are incomes which are taxed under the normal provisions at a rate lower than the MAT rate, then such incomes will have to be reduced from their book profit. There are two types of incomes. One is this capital gains and another royalty, foreign technical services, and I think one or two other items which are liable to tax only at 10% under section 115A, 115A, correct. This is a fundamental rule, when the income is not included in book profit, automatically expenses relating thereto will also have to be taken out of the profit and loss account. Otherwise, that expenses will go to reduce your other profits, which should not be the case. Now you know, in that real estate business, they are planning to start what is called as the business trust. The scheme operates like this: a big company which is engaged in construction activities, for the purpose of its real estate business, will form a separate special purpose vehicle, or which is nothing but a company. It will invest in the capital of that company, which is nothing, will become a subsidiary of that company. That subsidiary company will thereafter buy the land, develop it into a residential complex or a commercial complex, and then sell it to prospective buyers. So once that is done, either that company is dissolved or merged with the parent company. it becomes easy for them to maintain the accounts, and there are so many other benefits to be derived if it is made as a separate company. So they will have several such special purpose vehicles. But ultimately, entire thing will have to be funded by this parent company which is making that SPV. In order to allow the public to participate in that, they have devised a scheme of forming what is called as a business trust. It operates like this. This company which has formed this SPV would have invested in the capital of the SPV, which means that the holding company will have shares of that SPV. This holding company will thereafter create a business trust which will issue units. After forming the trust, it will transfer its shares to that business trust. Business trust will allot units to this holding company. Business trust will also allot units to public at large by collecting money from them. Now this trust will come to acquire this SPV. It can finance the SPV as much as it wants because it is going to collect the money from the public. This company which has initially sponsored the trust, if they want money, they can sell the units in the public and get the money back. Otherwise, initially they were holding shares. Selling those shares becomes a very difficult proposition. Whereas if it is units which are listed on the stock exchange, it becomes that much easier for them to do that. Now, under income and normal provision, section 47, which provides for treating certain transactions as not a transfer for the purpose of capital gains, contains a provision which says that when this company transfers its shares in that SPV to the business trust as not a transfer for the capital gains purposes. What does that actually mean? It will get units, and to the trust it will give the shares. There is actually a transaction that is happening of transfer of a capital asset. But because section 47 becomes operative, which says that it will not be treated as a trust, there will not be the obligation to pay the capital gains. Finally, this company will pay the capital gains only when it sells the units to the public. But when it prepares its profit and loss account, when it transfers the shares to the trust, it has to record the transactions. It will have to record the transaction, and there will be a value for the transaction. So it may end up in a profit or a loss, which even though it is a notional, but nevertheless it will compensate in its profit loss account. So this net profit will be including such notional profit or loss. Unless an adjustment is provided, such notional profit or loss will also suffer tax. Therefore, there is an adjustment that is provided for that. Such notional profit or loss is ignored. It is taken out of the net profit. Such companies become liable to pay the tax only when they sell the units in the open market. That time, cost of the units will be the cost that they have initially incurred to acquire the shares of that SPV.
There is no such case, practical case of units being listed in the stock exchange as of now.
They are saying in September they are going to do that. It has been getting postponed. Yeah, this is another little interesting section. There is a section called 115 BDF. If an Indian company invents any patent and thereafter transfer the right to use that patent, they will get royalty. Now this royalty has to be subjected to tax. Under that section, they say instead of arriving at the net profit, we will give you an option. On the royalty amount, whatever you are issued, you pay 10%. This is sort of presumptive tax. Instead of finding out what is the expenses incurred to earn that royalty and arrive at the net profit and then taxing it, they are saying on the royalty itself you pay 10%. Now the tax rate is only 10% there. This royalty income gets included in their profit and loss account. It is a domestic company. For the purpose of 115 JB, this royalty income is included in your net profit and consequently therefore at book profit. So you will end up paying 18.5% on that. So one section provides for 10% tax, another section simultaneously provides for 18.5%. For this they have provided an adjustment. Such income has to be taken out of that profit and loss account. It has to be taxed under 115 BBF itself. Rest of the profit, if it is liable for MAT, it will be taxed under 115 GB. So therefore, if this is a case, simultaneously a given company will be paying tax both under 115 JB and under 115 BBF. To the extent of royalty income, they will be paying tax under 115 BBF at 10%, and on the rest, they will be paying tax under 115 JB. Depreciation. When you prepare the profit and loss account, you provide depreciation. In the normal circumstances, there should not be any problem. The issue arises if you have any assets which you have revalued. You have an asset which you have acquired 10 lakh, today its value is 1 crore, so you have revalued. So you will start depreciating that 1 crore worth of assets today. So there will be a higher charge of depreciation to your profit and loss account. This they want to address. What they have done is, because that higher amount of depreciation is actually notional, you have revalued the asset and that revaluation reserve is sitting in your balance sheet, but the charge is coming and hitting your profit and loss account, thereby you are actually suppressing your profit for that year. Therefore, for this entire depreciation exercise, what they have done, whatever depreciation you have charged to your profit and loss account, first you add it back. That means you neutralize the effect of the depreciation you have charged. Then they are saying, from the net profit, you deduct the depreciation that is allowable on cost. Now it is a normalized profit. Whatever depreciation is there, if at all it is there, which is attributable to this revalued amount, that you ignore. So your profit and loss account becomes a normalized profit and loss. Now, while we are on this revaluation, this revaluated asset, if it gets sold, what will happen? You will realize this revaluation reserve. I hope you are clear. When the revalued asset is sold, you will recover the revaluation reserve. But what is the entry you will pass? First entry, when you are selling the asset, your bank account will get debited and your asset will get credited. This revaluation reserve becomes a realized amount. You have a choice under AS 10 either to take it to profit and loss account or directly transfer it to general reserve. If you transfer it directly to general reserve, it will not come to your profit and loss account. If it doesn't come to your profit and loss account, it will not get included in your net profit. If it doesn't get included in net profit, you will not be paying MAT on that. This is one of the tax planning that was being done earlier. Now they have plugged this loophole and they have said in such cases that the revaluation, the reserve which has been realized, has to be added to your net profit if it is not already credited to your profit and loss account. There might be other income. For example, if a company receives non-compete fee, company might receive non-compete fee. Instead of crediting it to profit loss account, I will directly credit it to general reserve. Is it permissible? Where does it say that such incomes will have to be necessarily credited to profit loss account? Section 20, does it say that? No, 28, it is a normal provision. See, we are preparing a profit and loss account under the Companies Act. What is relevant for our purpose is if there is something in the Companies Act, that is Schedule 3, or if there is something in accounting standard. If it is directly credited to general reserve without routing it through profit and loss account, I will be avoiding MAT. But what happens is, if you have gone through accounting standard 5, it says all income shall be credited to your profit and loss account. Now, whether this non-compete fee is an income, again, income is defined as any gains or profits. This is in the nature of a gain. Profits means which is normally from your normal activities. This is exceptional activities. If you get any profit, it is called as gains. This is a gain. Therefore, it is also an income. Therefore, there is a need to route it through profit and loss account. If it is not done so, then that financial statement or profit and loss account which is prepared is not in accordance with the accounting standard. Profit and sale of goodwill which is not recorded, same story will apply. Deferred tax, both deferred tax assets and liabilities. Again, it has to be either added back or it has to be reduced as the case may be. Provision for diminution in the value of any asset. Like somebody was, you are suggesting bad debts, provision for bad debt. Debt is an asset. If you have made a provision for diminution in the value of that asset, which is nothing but a provision for bad debt, it has to be added back. That means your net profit will get increased, your book profit will become more, you will be paying MAT on such amount. Amounts withdrawn from reserves or provisions and credited to profit loss account. Now, when you have created the reserve, if you have added it back and paid MAT on that, then when such reserve, when it is credited back to your profit loss account, then you don't have to pay MAT on that. How do you ensure you don't pay MAT on that? Your net profit has to be reduced by such reserves. Same is the case with the provisions. Now, this insolvency and bankruptcy code that is in the news, companies which are before such adjudicating authorities, they become very unattractive if their losses are not allowed to be carried forward. Because for MAT purposes, you have a provision, only lesser of brought forward losses or depreciation is allowed to be set off from your current profit. Such companies looks very unattractive for a prospective purchaser if he doesn't get the benefit of this loss. Therefore, they have made a special provision. Total of both brought forward losses as well as depreciation will be allowed to be carried forward and set off against MAT, set off against net profit to arrive at book profit.
Sir, I think it is to this other section where ownership changes. Then you cannot, the new owner cannot.
That is under section 79 of the income tax.
Is that the same as this? Is that the same as this?
No, this is not the same as that. This is different. See, that is only for the limited purpose of income tax. Here we are looking at all these items under the Companies Act. It is allowed. Adjustment for losses brought forward or unabsorbed depreciation as per the books of account. Now, we have all seen the balance sheet, we have seen the books of account. You don't bifurcate losses and depreciation separately in your books of account. Correct? In your books of account, there will be only one figure, brought forward losses. Losses includes depreciation. But for the purpose of income, 115 JB, they say it has to be bifurcated. Even though in the books, if there is only one amount, you will have to necessarily bifurcate into two parts. Find out which is less, only that is allowed to be set off from the current year's profit. If one is nil, you don't get deduction on account of this. There are a lot of issues that will arise if you have been making losses for the say past 10 years. Whether you add all of that item or you compute the book loss every year and apply this 115 JB year on year basis. They give different results because let us say in a given year, there is book loss, there is book depreciation which is unabsorbed. Lower of the two, if it has to be taken, then you lose some portion of that loss. So the loss that gets carried forward gets reduced year on year. That is one way of looking at it. Other way is you go on adding all your losses, all your depreciation which is unabsorbed, then add it up, find out which is the lower one, deduct that from the current year profit. So there are still that matter is not resolved completely.
So the previous slide,
Yeah.
how many years can we carry for use the adjustment of losses? How many years can we go back and how do we start it?
No, I know the confusion here is you somehow slip to income tax provisions. I am saying Companies Act provisions. Under the Companies Act, there is nothing like carrying it forward and setting it up. In a given year, if you have got losses that is brought forward means that is earlier in losses. You have to split it into how much is loss excluding depreciation, how much is depreciation in that. There is no carry forward and set off. It is simply carried forward. It is not carried forward for set off. Otherwise your balance sheet will not tally. If that item is not there, balance sheet will not tally.
No, but in any case, this can be for 15 years, no? So it is limited to 15 years.
No, why 15 years?
Because you said that this MAT can be utilized only for 15 years.
MAT credit is allowed to be carried forward for 15 years. MAT credit can be carried forward only for 15 years. This is the way they have put it. See, foreign companies, if they are carrying on operations in India, they have to get themselves registered with the registrar of companies in New Delhi capital region, that is Delhi. Without that, a foreign company cannot carry on business. If they are carrying on business, then MAT will apply to them. If they are not carrying on any business in India, then they need not obtain registration. The law says if they have not obtained the registration, MAT provisions will not be applicable to them. Basically, it means that they do not have any operations in India. Now, there are provisions under the Income Tax Act where tax is paid on a presumptive basis. Like today, many of us are 44AF, I think. Some 8% of your turnover can be declared as profit and you don't have to maintain the books of account. Similarly, for many foreign companies, depending upon the activities that they carry on, they need not maintain the books of account, but they can offer certain percentage of their turnover as profits and pay tax on that. All these provisions are 44BB, I think it deals with shipping companies, foreign shipping companies. Their receipts on account of loading in Indian ports, that is taken as the basis. Out of that, if they declare 7.5% as their profit, which is taxable in India, then they don't have to produce any books of account, none of those things. So such companies are not required to pay tax under 115 JB. Again, this is an option to given such companies. If they say our profit is not going to be that 7.5%, then they have to maintain proper books of account. They have to establish that their profit is less than 7.5%, and then they are allowed to pay tax on actual profit. For such companies, 115 JB will become applicable. Regarding Ind AS compliant companies, there are, I don't know how many of you are familiar with new Indian accounting standards, Ind AS, because you got a totally different concepts, comprehensive income, other comprehensive income, total comprehensive income. If you are not familiar, we will not get into that. For example, when you revalue an asset, it will not get credited to your profit and loss account. It will get credited to something like your appropriation account. That is, after the net profit, there is an item called other comprehensive income. It will get credited there. Similarly, it will be shown under your equity. So there are a lot of things are there. So if you are not familiar, we will not get into this. Now, this is how you arrive at the book profit. You start with the net profit, make all these adjustments, you arrive at a figure which is called the book profit. On such book profit, you will have to calculate 18.5% plus the applicable cess and surcharge will have to be paid. Now, on one hand, you pay this MAT. What happens to your brought forward losses under income tax, unabsorbed depreciation under income taxes, whether that will get affected? Because you may not be paying MAT every year. This year it may be MAT, next year it may be normal tax. Nothing is going to happen to all those brought forward items. You are going to compute the normal total income and the normal taxes, assuming that nothing has happened, you are not paid tax under 115 JB, except that you don't pay tax under normal rates, you pay tax under 115 JB, but your carry forward claims and claims with regard to depreciation and losses will get changed, and the way it will be carried forward will be such changed figures will get carried forward to the next year. Basically to say, because you have paid tax under 115 JB, your normal income tax calculations will not undergo any change. Finally, what happens if you have not reported your book profit properly? Because book profit is going to be your total income if you are going to pay tax on 115 JB. From this year onwards, your penalty provisions have undergone a dramatic change. It is no longer 271(1)(c), where there used to be concealment of particulars of income or furnishing inaccurate particulars. Now, your offences will be classified into two broad categories. One is under-reporting of your income, another is misreporting of your income. They have given circumstances where this reporting gets classified as misreporting and circumstances where it gets classified as underreporting. If it falls under the category of underreporting, it is considered as a milder offence. The penalty will be 50% of the tax on such underreported income. On the other hand, if it falls under the category of misreported income, penalty will be 200% of the tax on such misreported income. So this is all about MAT. Now we will see something about transactions of securities on which they make capital gains. They are required to pay only 10%. If their tax liability is only 10% under the normal income tax provisions, if you make them pay tax under 115 JB, they will end up paying 18.5%. They will run away. Therefore, there is a special provision under 115 JB where they say, in respect of these foreign companies, if there are incomes which are taxed under the normal provisions at a rate lower than the MAT rate, then such incomes will have to be reduced from their book profit. There are two types of incomes. One is this capital gains and another royalty, foreign technical services, and I think one or two other items which are liable to tax only at 10% under section 115A, 115A, correct. this is a fundamental rule, when the income is not included in book profit, automatically expenses relating thereto will also have to be taken out of the profit and loss account. Otherwise, that expenses will go to reduce your other profits, which should not be the case. Now you know, in that real estate business, they are planning to start what is called as the business trust. The scheme operates like this. A big company which is engaged in construction activities, for the purpose of its real estate business, will form a separate special purpose vehicle, or which is nothing but a company. It will invest in the capital of that company, which is nothing, will become a subsidiary of that company. That subsidiary company will thereafter buy the land, develop it into a residential complex or a commercial complex, and then sell it to prospective buyers. So once that is done, either that company is dissolved or merged with the parent company. It becomes easy for them to maintain the accounts, and there are so many other benefits to be derived if it is made as a separate company. So they will have several such special purpose vehicles. But ultimately, entire thing will have to be funded by this parent company which is making that SPV. In order to allow the public to participate in that, they have devised a scheme of forming what is called as a business trust. It operates like this. This company which has formed this SPV would have invested in the capital of the SPV, which means that the holding company will have shares of that SPV. This holding company will thereafter create a business trust which will issue units. After forming the trust, it will transfer its shares to that business trust. Business trust will allot units to this holding company. Business trust will also allot units to public at large by collecting money from them. Now this trust will come to acquire this SPV. It can finance the SPV as much as it wants because it is going to collect the money from the public. This company which has initially sponsored the trust, if they want money, they can sell the units in the public and get the money back. Otherwise, initially they were holding shares. Selling those shares becomes a very difficult proposition. Whereas if it is units which are listed on the stock exchange, it becomes that much easier for them to do that. Now, under income and normal provision, section 47, which provides for treating certain transactions as not a transfer for the purpose of capital gains, contains a provision which says that when this company transfers its shares in that SPV to the business trust as not a transfer for the capital gains purposes. What does that actually mean? It will get units, and to the trust it will give the shares. There is actually a transaction that is happening of transfer of a capital asset. But because section 47 becomes operative, which say that it will not be treated as a trust, there will not be any obligation to pay the capital gains. Finally, this company will pay the capital gains only when it sells the units to the public. But when it prepares its profit and loss account, when it transfers the shares to the trust, it has to record the transactions. It will have to record the transaction, and there will be a value for the transaction. So it may end up in a profit or a loss, which even though it is a notional, but nevertheless it will compensate in its profit loss account. So this net profit will be including such notional profit or loss. Unless an adjustment is provided, such notional profit or loss will also suffer tax. Therefore, there is an adjustment that is provided for that. Such notional profit or loss is ignored. It is taken out of the net profit. Such companies become liable to pay the tax only when they sell the units in the open market. That time, cost of the units will be the cost that they have initially incurred to acquire the shares of that SPV.
There is no such case, practical case of units being listed in the stock exchange as of now.
They are saying in September they are going to do that. It has been getting postponed. Yeah, this is another little interesting section. There is a section called 115 BDF. If an Indian company invents any patent and thereafter transfer the right to use that patent, they will get royalty. Now this royalty has to be subjected to tax. Under that section, they say instead of arriving at the net profit, we will give you an option. On the royalty amount, whatever you are issued, you pay 10%. This is sort of presumptive tax. Instead of finding out what is the expenses incurred to earn that royalty and arrive at the net profit and then taxing it, they are saying on the royalty itself you pay 10%. Now the tax rate is only 10% there. This royalty income gets included in their profit and loss account. It is a domestic company. For the purpose of 115 JB, this royalty income is included in your net profit and consequently therefore at book profit. So you will end up paying 18.5% on that. So one section provides for 10% tax, another section simultaneously provides for 18.5%. For this they have provided adjustment. Such income has to be taken out of that profit and loss account. It has to be taxed under 115 BDF itself. Rest of the profit, if it is liable for MAT, it will be taxed under 115 GB. So therefore, if this is a case, simultaneously a given company will be paying tax both under 115 JB and under 115 BDF. To the extent of royalty income, they will be paying tax under 115 BDF at 10%, and on the rest, they will be paying tax under 115 JB. Depreciation. When you prepare the profit and loss account, you provide depreciation. In the normal circumstances, there should not be any problem. The issue arises if you have any assets which you have revalued. You have an asset which you have acquired at 10 lakh, today its value is 1 crore, so you have revalued. So you will start depreciating that 1 crore worth of assets today. So there will be a higher charge of depreciation to your profit and loss account. This they want to address. What they have done is, because that higher amount of depreciation is actually notional, you have revalued the asset and that revaluation reserve is sitting in your balance sheet, but the charge is coming and hitting your profit and loss account, thereby you are actually suppressing your profit for that year. Therefore, for this entire depreciation exercise, what they have done, whatever depreciation you have charged to your profit and loss account, first you add it back. That means you neutralize the effect of the depreciation you have charged. Then they are saying, from the net profit, you deduct the depreciation that is allowable on cost. Now it is a normalized profit. Whatever depreciation is there, if at all it is there, which is attributable to this revalued amount, that you ignore. So your profit and loss account becomes a normalized profit and loss. Now, while we are on this revaluation, this revaluated asset, if it gets sold, what will happen? You will realize this revaluation reserve. All of you are clear. When the revalued asset is sold, you will recover the revaluation reserve. But what is the entry you will pass? First entry, when you are selling the asset, your bank account will get debited and your asset will get credited. this revaluation reserve becomes a realized amount. You have a choice under AS 10 either to take it to profit and loss account or directly transfer it to general reserve. If you transfer it directly to general reserve, it will not come to your profit and loss account. If it doesn't come to your profit and loss account, it will not get included in your net profit. If it doesn't get included in net profit, you will not be paying MAT on that. This is one of the tax planning that was being done earlier. Now they have plugged this report and they have said in such cases that the revaluation, the reserve which has been realized has to be added to your net profit if it is not already credited to your profit and loss account. There might be other income. For example, if a company receives non-compete fee, company might receive non-compete fee. Instead of crediting it to profit loss account, I will directly credit it to general reserve. Is it permissible? Where does it say that such incomes will have to be necessarily credited to profit loss account? What is that? Section 20. Does it say that? No, 28. It is a normal provision. See, we are preparing a profit and loss account under the Companies Act. What is relevant for our purpose is if there is something in the Companies Act, that is Schedule 3, or if there is something in accounting standard. If it is directly credited to general reserve without routing it through profit and loss account, I will be avoiding MAT. But what happens is, if you have gone through accounting standard 5, it says all income shall be credited to your profit and loss account. Now, whether this non-compete fee is an income, again, income is defined as any gains or profits. This is in the nature of a gain. Profits means which is normally from your normal activities. This is exceptional activities. If you get any profit, it is called as gains. This is a gain. Therefore, it is also an income. Therefore, there is a need to route it through profit and loss account. If it is not done so, then that financial statement or profit and loss account which is prepared is not in accordance with the accounting standard. Profit and sale of goodwill which is not recorded, same story will apply. Deferred tax, both deferred tax assets and liabilities, again it has to be either added back or it has to be reduced as the case may be. Provision for diminution in the value of any asset. Like you are suggesting bad debts, provision for bad debt. Debt is an asset. If you have made a provision for diminution in the value of that asset, which is nothing but a provision for bad debt, it has to be added back. That means your net profit will get increased, your book profit will become more, you will be paying MAT on such amount. Amounts withdrawn from reserves or provisions and credited to profit loss account. Now, when you have created the reserve, if you have added it back and paid MAT on that, then when such reserve, when it is credited back to your profit and loss account, then you don't have to pay MAT on that. How do you ensure you don't pay MAT on that? Your net profit has to be reduced by such reserves. Same is the case with the provisions. Now, this insolvency and bankruptcy code that is in the news, companies which are before such adjudicating authorities, they become very unattractive if their losses are not allowed to be carried forward. Because for MAT purposes, you have a provision, only lesser of brought forward losses or depreciation is allowed to be set off from your current profit. Such companies looks very unattractive for a prospective purchaser if he doesn't get the benefit of this loss. Therefore, they have made a special provision. Total of both brought forward losses as well as depreciation will be allowed to be carried forward and set off against MAT, set off against net profit to arrive at book profit.
Sir, I think it is to, there's another section where ownership changes, then you cannot, the new owner cannot.
That is under section 79 of the income tax.
Is that the same as this?
Beg your
Is
pardon?
that the same as this?
No, this is not the same as that. This is different. See, that is only for the limited purpose of income tax. Here we are looking at all these items under the Companies Act. It is allowed. Adjustment for losses brought forward or unabsorbed depreciation as per the books of account. Now, we have all seen the balance sheet, we have seen the books of account. You don't bifurcate losses and depreciation separately in your books of account. Correct? No? In your books of account, there will be only one figure, brought forward losses. Losses includes depreciation. But for the purpose of income, 115 JB, they say it has to be bifurcated. Even though in the books, if there is only one amount, you will have to necessarily bifurcate into two parts. Find out which is less, only that is allowed to be set off from the current year's profit. If one is nil, you don't get any deduction on account of this. There are a lot of issues that will arise. If you have been making losses for the say past 10 years, whether you add all of that item or you compute the book loss every year and apply this 115 JB year on year basis, they give different results because every, let us say in a given year, there is book loss, there is book depreciation which is unabsorbed. Lower of the two, if it has to be taken, then you lose some portion of that loss. So the loss that gets carried forward gets reduced year on year. That is one way of looking at it. Other way is you go on adding all your losses, all your depreciation which is unabsorbed, then add it up, find out which is the lower one, deduct that from the current year profit. So there are still that matter is not resolved completely.
So the previous slide,
Yeah.
how many years can we carry for use the adjustment of losses? How many years can we go back and how do we start it?
No, I know the confusion here is you somehow slip to income tax provisions. I am saying Companies Act provisions. Under the Companies Act, there is nothing like carrying it forward and setting it up. In a given year, if you have got losses that is brought forward means that is earlier than losses. You have to split it into how much is loss excluding depreciation, how much is depreciation in that. There is no carry forward and set off. It is simply carried forward. It is not carried forward for set off. Otherwise your balance sheet will not tally. If that item is not there, balance sheet will not tally.
No, but in any case, this can be for 15 years, no? So it is limited to 15 years.
No, why 15 years?
Because you said that this MAT is can be utilized only for 15 years.
MAT credit is allowed to be carried forward for 15 years. MAT credit can be carried forward only for 15 years. This is the way they have put it. See, foreign companies, if they are carrying on operations in India, they have to get themselves registered with the registrar of companies in New Delhi capital region, that is Delhi. Without that, a foreign company cannot carry on business. If they are carrying on business, then MAT will apply to them. If they are not carrying on any business in India, then they need not obtain registration. The law says if they have not obtained the registration, MAT provisions will not be applicable to them. Basically, it means that they do not have any operations in India. Now, there are provisions under the Income Tax Act where tax is paid on a presumptive basis. Like today, many of us are 44AF, I think. Some 8% of your turnover can be declared as profit and you don't have to maintain the books of account. Similarly, for many foreign companies, depending upon the activities that they carry out, they need not maintain the books of account, but they can offer certain percentage of their turnover as profits and pay tax on that. All these provisions are 44BB, I think it deals with shipping companies, foreign shipping companies. Their receipts on account of loading in Indian ports, that is taken as the basis. Out of that, if they declare 7.5% as their profit, which is taxable in India, then they don't have to produce any books of account, none of those things. So such companies are not required to pay tax under 115 JB. Again, this is an option to given such companies. If they say our profit is not going to be that 7.5%, then they have to maintain proper books of account. They have to establish that their profit is less than 7.5%, and then they are allowed to pay tax on actual profit. For such companies, 115 JB will become applicable. Regarding Ind AS compliant companies, there are, I don't know how many of you are familiar with new Indian accounting standards, Ind AS, because you got a totally different concepts: comprehensive income, other comprehensive income, total comprehensive income. If you are not familiar, we will not get into that. For example, when you revalue an asset, it will not get credited to your profit and loss account. It will get credited to something like your appropriation account. That is, after the net profit, there is an item called other comprehensive income. It will get credited there. Similarly, it will be shown under your equity. So there are a lot of things are there. So if you are not familiar, we will not get into this. Now, this is how you arrive at the big book profit. You start with the net profit, make all these adjustments, you arrive at a figure which is called the book profit. On such book profit, you will have to calculate 18.5% plus the applicable cess and surcharge will have to be paid. Now, on one hand, you pay this MAT. What happens to your brought forward losses under income tax, unabsorbed depreciation under income taxes, whether that will get affected? Because you may not be paying MAT every year. This year it may be MAT, next year it may be normal tax. Nothing is going to happen to all those brought forward items. You are going to compute the normal total income and the normal taxes, assuming that nothing has happened, you are not paid tax under 115 JB, except that you don't pay tax under normal rates, you pay tax under 115 JB, but your carry forward claims and claims with regard to depreciation and losses will get changed, and the way it will be carried forward will be such changed figures will get carried forward to the next year. Basically to say, because you are paid tax under 115 JB, your normal income tax calculations will not undergo any change. Finally, what happens if you have not reported your book profit properly? Because book profit is going to be your total income if you are going to pay tax on 115 JB. From this year onwards, your penalty provisions have undergone a dramatic change. It is no longer 271(1)(c), where there used to be concealment of particulars of income or furnishing inaccurate particulars. Now, your offences will be classified into two broad categories. One is under-reporting of your income, another is misreporting of your income. They have given circumstances where this reporting gets classified as misreporting and circumstances where it gets classified as under-reporting. If it falls under the category of under-reporting, it is considered as a milder offence. The penalty will be 50% of the tax on such under-reported income. On the other hand, If it falls under the category of misreported income, penalty will be 200% of the tax on such misreported income. So this is all about MAT. Now we will see something about whatever. No, one more slide is there. I want to do something. Now we will see little bit about alternate minimum tax. Alternate. Fortunately, alternate minimum tax is a defined term. In 115 JC, you have the definition of alternate minimum tax. MAT is applicable to corporates. Alternate minimum tax is applicable to non-corporate SSEs. Accordingly, it will apply to individuals, HUFs, partnership firms, LLPs. All these people are covered under alternate minimum tax. There is normal tax, there is alternate minimum tax. Everybody is expected to pay alternate minimum tax, but there are certain exceptions. Rate of alternate minimum tax same as that of MAT, that is 18.5%, but this is only the rate. When you actually pay, there will be cess plus surcharge has to be loaded to that. What is the tax base on which you will calculate this alternate minimum tax or AMT? You start from the total income. There you started from your net profit figure. Here you start from the total income, that is the final total income. That means you will have to compute your income under normal provisions and arrive at the total income. So anything here will be only additions, because they want you to pay more tax. So there will be additions to this total income. What are the additions that need to be made? One is under chapter 6A, there is one section called other special incomes, which starts with 80H and goes on up to I think 80 RRB or something like that. These are basically deductions by way, these are basically incentives by way of deduction for setting up industries in backward areas or SCZ. SCZ comes under 10A, that also needs to be added back. And finally there is one section 35AD where you get a deduction for your entire investment in capital assets. From the total income, you get a deduction of the amount that you have invested in the capital assets. All these deductions you would have claimed in determining your total income. To find out the, what is the word there, adjusted total income, you add back all these deductions. On that adjusted total income, you calculate 18.5%. That is the alternate minimum tax one has to pay. Only for cooperative societies, there is an exception. They don't have to add back to their total income whatever deductions they have claimed under 80B. As in MAT, there was a requirement to file the certificate from the Chartered Accountant in Form 29B. Under AMT, there is a requirement to file a similar certificate, but in Form 29C. the tax that is paid as AMT and the tax you would have paid on your total income under normal circumstances. The difference between the two is available to you as a tax credit, which again can be carried forward for 15 years. And setting off again in the same manner as in MAT, that is, if the tax that you are going to pay at normal rates is more than AMT, to that extent, in that year, to the extent of difference between normal tax and AMT, you can claim set off. It will not apply to those who have not claimed any deduction under heading C of chapter 68, that is ATH deduction and all those. There is no problem in claiming deduction under ATC and all those, that is not affected. It is only for the incentive. If somebody has not claimed any deduction under 10AA, that is SEZ deduction, or if somebody has not claimed any deduction under 35 AD, or individuals and HCFs, if their adjusted total income is less than 20 lakhs, then also they don't have to pay AMT. Otherwise, there is nothing much in AMT.
I have read somewhere that that 1038 which you said in corporate it has to be added back.
Correct.
In the case of LLP it has not to be added back.
For LLP, MAT is not applicable at all.
You said AMT.
AMT, no, AMT, I never said it has to be added back.
So all 10, no, see, under MAT you said 1038
Correct.
is the only section
On
which
which,
is-
on which somebody has to pay MAT.
correct. But
Correct.
under AMT,
There is no MAT and there is no AMT on 1038 income.
yes.
Correct. There is no tax on that.
So AMT applicable for individuals?
Bigger pardon?
Individuals, AMT applicable for
AMT is applicable to all non-corporate SSEs. Individual is a non-corporate SSE, so it is applicable. Provided his adjusted total income is less than 20 lakhs.
It need not be a business income.
Bigger pardon?
It need not be a business income.
No. It is with reference to total income. Total income. You see, ultimately, both MAT and your AMT is with the reference. MAT is the reference to your profit and loss account. It is not with the reference to your different heads of income. AMT is with the reference to your total income. Any other questions? So, if there are no other questions, then we will call it a day. Come again? Whichever is lower.
Suppose the company is making loss from 20-30 years.
20-30 years it is making losses.
Now, bifurcation of the what is the business loss and depreciation loss is what going to be a challenge. How do we deal with those cases? The company that we do not have the bifurcation. Really, we go and think what is the depreciation, what is the business loss. To the extent we can
See, what happens is, if any of these two items is nil, then you don't get any deduction. Correct? No? So, unless you bifurcate, you will not be able to prove that one of them is nil. Sorry, unless you bifurcate, there can be a presumption that one of them is nil. So, in which case you lose the benefit. Therefore, it is in your interest that you take some trouble and bifurcate. You are saying you may not have your financial statement for the past 20 years. No, if you are having the financial statement, then it should be easier. No? Because you have the profit and loss account, you have the net loss, then you know the depreciation. From the net loss, if you take out the depreciation, you get the bifurcation of both.
We get the accumulated depreciation schedule.
Accumulated depreciation?
In a depreciation schedule as per computer. We can consider that as a depreciation.
That's a good point. That's a good point.
100 BBF
Yes.
royalty, what you told,
Correct.
has to be paid at 10%.
Correct.
That is 100 BBF is I suppose domestic as well as international, whatever it is. It is not
Domestic.
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 Now, a holding company takes a, or holding or maybe a group company which majorly, let's say specifically Godrej Industries, where they have the major control. They take royalty from Godrej Consumer, Godrej others.
See, there are two things. This 115 BBF deals with the royalty for use of patent developed by such company.
Not the name.
Not the name. This is a copyright you are talking. Brand name. It is not copyright.
So in case of a foreign company,
Just one thing.
In the same case, carry forward of business starts at the depreciation. So we need to go year on year, and we can do it as an.
There is one confusion. One is to find out the accumulated business loss other than depreciation, and similarly compute the accumulated depreciation, unabsorbed depreciation. Find out which is the lower one. Deduct that. There is another argument which is every year you see depreciation is more or business loss is more. Take the lower of that and then add it up. That is true.
Some people will suggest that do it at overall basis, as he said, take out the accumulated depreciation, remove from the carry forward losses, and arrive which is the lower. Another way, year on year, you depict the quantity of business, what is the depreciation, assuming that the business loss is zero. In that year, you will be taking as a zero for the
Law simply says brought forward loss excluding depreciation or unabsorbed depreciation, whichever is lower, has to be reduced from the net profit to arrive at a book profit.
So, but how long do we go back? Say, he said, for example, continuing his example, we say 20, 30 years. So, there is no limit to how far we can go back and claim that.
I will put it back to you. If you have not made profit for the last 20, 30 years, it is unthinkable that suddenly this year you made a profit. So there is no time limit as far as this is concerned. That's what I was telling. You will have the financial statement. And every year you would have computed math. It is not that suddenly you are talking about math. Every year you would have done that. So you will have that figure readily available.
This might be actually a awkward question. So if I'm asking something untoward, please forgive. Is there any other country where the subjects are treated like enemies by the tax system? But here there is a lack of trust.
I will answer it in slightly different manner.
This is not
There is no country where the taxpayers are in love with the tax authorities. I think that should answer your question.
Taxpayers are
Not in love with the tax authorities.
Yeah. Is this not a British legacy that they had started the tax system basically to fleece the public of India way back in 1922? And the same mindset continues, whoever is administering, regardless of we call it democracy or whatever it is.
There is a very famous saying, British have left India a long time back, but still they rule us from the grave.
So I have one question.
Yes.
Related to foreign companies, let's say a foreign company has a permanent establishment in India.
Correct.
So they would prepare the books of accounts pertaining to the income for the branch.
Correct. That is being in India.
Yeah. So there are few treaties which says in case if the foreign company makes direct sales in India, they would apply force of attraction.
Correct.
And they will include that income also in the branch income. Now for the purpose of MAT, should I also include the income of the foreign company?
No.
So not
No.
required.
What happens is, all that force of attraction, all those things, it is to quantify the tax under normal provisions.
Yes.
Correct? No? So for that purpose you compute. Whereas for MAT purposes, it is purely based on your books of account. You do not look into anything which is outside the books of account.
for the purpose of AMT, the HUF or LLP should necessarily carry on a business.
No, not necessarily.
No, but 18.5% we said is the effective tax rate of the businesses corporate all over.
That is corporate. That is
Correct.
for
Here
MAT.
also it is the same rate.
That is for MAT. Here there is no basis because MAT is 18.5%. They are saying AMT also let it get 18.5%.
They need not have business income, only
No,
capital
no.
gains income, then also it will
Yes.
18.5%.
But
And
the issue arises if they are having only capital gains income, then your AMT that provisions will not apply at all because I just showed you these provisions will not apply if somebody has not claimed any deduction under 10AA, that is SEZ unit, they are not there. Under 35 AD, that is coming under your professional gains of business, or under the chapter 6A heading C, deduction in respect of certain income. All those are business income. So for them, AMT, your alternate minimum tax provisions will not apply at all. Anything? Right. So